Okay, so guys, we want to start with question number 18 from the handout. This sum is a combination of bond valuation and also the mutual fund chapter. Now, where you have been asked to calculate the net asset value of a fund investing their money in debt instruments.
Yes.
It is a debt fund. You are supposed to calculate the NAV for this particular fund. Now let us go ahead and take on this example. This example is from 2016 RTP. Yes.
Based on the following data, estimate the net assets value NAV on 1st July 2016 on per unit basis of a debt fund.
Point note, you have been asked to calculate the NAV of this particular fund as on 1st July 2016. 1st July. Fine. Next.
Name of the security 10.71% GOI 2028 bonds.
Okay.
Face value 100. Purchase price is 104.78. Maturity 31st March 2028. Number of securities 1 lakh. Coupon dates 31st March. Duration of bond 7.3494.
So point to note, this particular bond pays interest on 31st March each year, right?
Yes.
Now when you're going to calculate the NAV on 1st July 2016, please remember, you would have received the last coupon on these bonds on 31st March 2016. Therefore, 3 months interest would have accrued by 1st July 2016. Am I right? That is April 2016, May 2016 and June 2016. Got it? So, interest for 3 months will be accrued on these bonds, which will be considered as an asset. Interest accrued, right? For 3 months is an asset. That should be considered. Next.
Next 10% GOI 2023 bonds, 100 face value, 100 purchase price,
Okay.
31st March 2023 maturity date, 50,000 securities,
Okay.
31st March and 30th September coupon dates, and 5.086 coupon.
So it is given that is a semi-annual pay bond. This bond pays interest to you people, the holder of these bonds, a mutual fund, on 31st March and 30th September. Because you're going to calculate the NAV on 1st July 2016, you can say the last interest would have been received on 31st March 2016. Again, 3 months interest will be accrued, right, on these bonds. The months April, May and June. 3 months interest accrued on these bonds until 1st July 2016. Next.
Next, 9.5% GY 2021 bonds, 100 face value, 97.93 purchase price, 31st December 2021 maturity date, number of securities 40,000, coupon dates 30th June and 31st December, and bond duration 4.3949.
It is given that the coupon dates are 30th June. Therefore, on 1st July 2016, when you're going to find the NAV, there will be no interest accrued on these debentures as on 1st July. Got it? Because the previous interest date is 30th June, a day before. Therefore, interest accrued will be 0. Next.
8.5% SGL 2025 bonds, 100 rupees face value, 91.36 purchase price, 30th June 2025 maturity date, 20,000 securities, 30th June coupon date, and 6.5205 duration.
So in this case, only once you receive the coupon, but on June 30th. Therefore, when you're going to calculate the NAV on 1st July 2016, there will be no interest accrued on these debentures, right? Therefore, no interest accrued on the third and the fourth bond. Next.
That's it with the chart.
The
next. Number of units is rupees 10 face value each, 1 lakh.
There are 1 lakh units outstanding on the balance sheet of the fund. Next.
All securities were purchased at a time when applicable yield to maturity was 10%.
Please remember the YTM is 10%. Always remember the YTM is a per annum YTM. Okay, so 10% is a YTM when all these bonds were purchased. 10% YTM. Next.
On NAV date, the required yield increased by 75 basis point and
It is given that the yield increased from 10% to how much? 10.75%. You all know that when the yield increases, the bond price will fall. Is that fine? Next.
and cash in hand and accrued expenses were 6,72,800 and 2,37,400 respectively.
So cash in hand is an asset and accrued expense is a liability. Next.
That's it with the question.
Now you have been asked to calculate the NAV. But here the crux is they given the duration in the question. Now using the duration which is given in, what is the duration given for the first bond? The first bond, what is the duration?
7.3494
years, right? So those are when simply duration given, it means what? They given the Macaulay duration. And you all know that I can find something called the modified duration. Just see the formula on the screen, guys. So what is a formula for modified duration? You are supposed to take the Macaulay duration, divide that by 1 plus YTM by N. N stands for, if it is an annual interest paying bond, divided by 1. If it is going to be a semi-annual interest paying bond, divided by 2, because you want to get 2. There are 2 payments there are 2 periods or 2 half years, right? Divided by 2. So therefore, what you should do, you are supposed to take the duration given in years, the Macaulay duration, and divide that by 1 plus YTM, which is given as 10%. It can be taken as 10% as it is 0.1 if it is an annual interest paying bond. Got it?
Yes.
If it is a semi-annual interest or coupon paying bond, divided by 2 periods involved. Now, just see the first calculation, the first working. Let us calculate the interest accrued on the first 2 bonds. And you know that always interest will be calculated on the
face value.
Face value of the bond. Therefore, there are 1 lakh bonds, the first one, right?
Yes, sir.
1 lakh bonds, face value rupees how much? 100 each. 1 lakh bonds into rupees 100 per bond. That into 10.71 by 100 is the rate of interest. That into 3 months, April, May, June 2016, 3 months interest accrued into 3 by 12. How much you get?
We get 2,67,750.
And then the second bond, I think there are 50,000 numbers, right? 50,000 bonds into face value how much? Rupees 100 each, face value. That into 10 by 100 is the rate of interest. Again, 3 months, doesn't matter, March and September. Since we are going to compute NAV on 1st July 2016, you have to see what is the last interest rate. Would have been 31st March. So 3 months gone by. Therefore, into 3 by 12, that is April, May, June interest accrued. How much?
It is 1,25,000.
Then add both, and that is a total amount of accrued interest, which is an asset, right?
3,92,750.
With that, you complete that part. Now you are supposed to calculate the market value. Now the market value of these 4 bonds after the yield has increased by 75 basis point. Got it?
Yes.
That is where you are supposed to find the modified duration and use that to calculate the market value of the bonds. Now let us take up the first bond. Which one? The 10.71% Government of India bonds, right?
Yes.
Remember, those bonds are bought at rupees how much? You bought 1 lakh bonds at rupees 104.78,
78.
right? Which is rupees 1 crore
4 lakh.
4 lakh and 78,000 is the amount invested, purchase price. Is that fine?
Yes, sir.
Then the duration given is what?
3494.
Now what you should do, I am supposed to find the modified duration. But what they did, they made one column showing the bond's volatility after a 75 basis point change. Got it? But I'll tell you what you should understand. Take a calculator, guys. What is 7.3?
3494.
Divide that by 1 plus YTM. Since it is an annual interest paying bond, 1 plus, you can take 10% as it is, right? It will be 10 by 1. So 0.1. So now tell me, what is 7.3?
3494.
Divided by 1.1?
6.681.
That is a modified duration, guys. But that, what is the meaning of the 6 point? For every 1% change in yield, the bond price will change by that percentage, right? But here the 75 basis point, which is 0.75%. Now this into 0.75 you do, how much?
We get 5.011.
Therefore, there will be a 5.011% negative change in the bond value. You know why? Because when the yield increases, the bond price will decrease. Got it? Because the bond price and yield are inversely related. Is that fine?
Yes.
So once the yield increases, the bond price will decrease. Therefore, apply 5.011%, that's negative, right? On rupees 1 crore 4,78,000 market price, the price you paid for the bond. From that, it will fall. Got it? On 1 crore 4,78,000, apply 5.011% into, that is 5.011 by 100. How much you get? Negative?
5,25,053.
This is a fall in the bond price. Therefore, how to get the now market value on 1st July 2016? From 1 crore 4,78,000, subtract
5,25,000.
that is all. How much you get? 99 lakh?
52,947.
That is all. Such a wonderful sum. You know that? They are testing your understanding of duration, maculae and modified duration in determining the market value of these bonds, which will be considered for calculating the NAV of the fund. Is that fine?
Yes.
Got it? Now just see the second bond. But remember, the second bond I think pays
10%.
interest every 6 months. Semi-annual pay bond. Please remember that. Okay?
Yes, sir.
Pays on March 31st or September 30. Doesn't matter, but 2 coupons, right?
Yes, sir.
So it's a semi-annual pay bond, SAP bond. Now just see, the purchase price is 50,000 bonds bought at rupees 100 each. What is the amount? 50 lakh. Then what is the duration of the bond?
It is 5.086.
Given, right? In years. Divide that by 1 plus YTM by N. What is the YTM? You know it's 10% given in the question. What is N? How many periods interest is paid? 2 periods. So divide by 2. What is 10 by 2? 5%. Therefore, just say 1.05. Exactly. You know, when this sum came in RTP, people were wondering. They are wondering why has it taken 1 plus 0.05? Because it is a semi-annual pay bond and the formula for modified duration is a maculae duration divided by 1 plus YTM by N in the 2 periods, right?
Yeah.
So therefore by 2. So by 1.05. So how much you get?
4.843.
That is supposed to be the modified duration, and that into 0.75.
3.6329.
That is a percentage change in the bond value. Apply this on 50 lakh and minus how much?
Minus 1,81,645.
Then you subtract and get the market value. How much?
48,18,355.
Let's go to the third bond, right? The third bond, what is?
9.5% GY 2000.
Okay, how many units? How many bonds?
It is.
What is the face value? 100 each.
Yes.
What is the amount given?
It is 100 each face value, 40,000 bonds.
40,000 bonds.
97.93 is the value in which we bought.
We bought. Okay. So 40,000 bonds into 97.9.
Wait.
Let's go to the.
97.93.
That is all. 40,000 bonds into rupees 97.93. That's it. How much?
39,17,000.
Okay. Now to find the volatility, what are you going to do? Again, take the duration in years given.
4.39.
Again by 1.05 because it's a semi-annual pay bond. 1 plus YTM by N. Okay. And then that into 0.75. How much is it?
3.1392.
Again, apply that percentage on the purchase price, subtract, right?
Minus 1,22,960.
And what is the now market value?
37,94,230.
This will be the bonds market value on 1st July 2016 after the yield has increased by 75 basis points, right?
Yes.
Let's go to the last bond. Again, that's a annual bond. Okay, annual interest, paying bond. So therefore, how many? I think 20,000 units, right? 20,000 bonds.
20,000 bonds, 91.36 purchase.
What is the amount purchase value?
So we get 18,27,200.
Very good. Now duration by 1.1 into 0.75. How much?
4.4456.
Then apply that on the purchase price minus
81,230 minus.
After minusing 17 lakh.
45,970.
That's it. Now please make a total of the last column. That is supposed to be the market value of all the 4 bonds held by the fund. Is that fine?
2,03,11,500.
Basically, that is basically the asset side of the fund balance sheet, right?
Yes.
These are the 4 investments they have, and you got the market value of those 4 investments. Fine. Now let's compute the NAV. We know that, find the total assets of the fund. Take this 2 crore.
3,11,500.
And then add cash in hand, how much?
6,72,800.
Also add interest accrued asset, how much?
3,92,700.
Is a total of assets. 3 lakh?
3,92,750 interest accrued.
And then adding up all the 3, you get the total of assets. Right?
2,13,77,053.
And then from this, you got to subtract only one liability, that is accrued expenses. After minusing, what is the net amount you get finally?
2,11,39,653.
And divide that by 1 lakh units are outstanding. You'll get the NAV per unit. How much?
211.4.
That is all, guys. Is that fine?
Yes.
So learn this example really well for your examination. Very, very important. Okay?
Yes.
You can pause the recording and jot down the solution.
Yes, sir.